Will Google stock go up this week? Because on the last hour of the last trading day, Friday, December 15, at 3:21 at the 5-second mark, we detected these options expiring December 22, which is this Friday, the 137 strike calls. 1,577 contracts, paying $50 each. So what does this mean? Let's take a deeper look, as usual. We can see here that the December 22s that expires this Friday, there were 14,000 volume, much greater than the open interest. So we know that these are opening trades. We are also in this position as well. They simply bought to open the 137 strike calls. And you can see here that this is a bullish long trade. Okay, just 27 positive delta here. Okay, but we have a very, very high theta time decay risk, -11, because it expires this week. So that is why we did not position size very much and just simply took the same trade, because this does not cross our threshold of a high probability trade. If you are interested in those types of trades where we have higher probabilities, make sure to go to our website to learn more on how you can gain access to those stock picks. We can see here also that the total value of this trade is also not very high. 1,577 times $50 each is only about $78,000. However, if we take a look at the other trade here, the one that is the biggest on December 15, these 2,976, what does this mean? Okay, well, if we take a look at the time, you can see that actually it all happened simultaneously with another trade. This one here, 137 strike calls, which is the same strike as the one we were just discussing. Okay, so this one is 141 strike calls, 2,976. Now, notice what happens when we take 2,976 and divide by 2. We get 1,488, which is this right here. So we know that this is a ratio spread. Now, what does a ratio spread do? So in this case, we can see what they did by going to the December 29th. Okay, that's in 12 days away. What they did was they bought the 137 strike calls, and then for the 141s, you can see here that the volume is a lot greater than the open interest. So we know they sold these to open, and what they did was they sold 2 for every one of the 137 strike calls. And so when you analyze this trade, you can see what this trade is. This is a back ratio spread. This is essentially what they're doing. You can see that if Google goes up, this trade becomes profitable. However, if it goes up too much and breaks this level here, about 145, right here, then they could lose money here, okay? Because this curve is now below the zero profit loss line, okay? So anything below this is a loss, anything above is a gain. And so notice why they did this strategy, because they're also not too sure. If Google goes down, they're actually hedged. They're not going to lose very much, okay? And this trade, because it's a $4 wide spread here, each of these spreads requires 400 buying power. Okay, and since they did about 1,488, this was a buying power about $595,000. Okay, so this is more significant than the trade we went over initially, but this is still, you can see here, if we take a look at the delta, it's a -1. Okay, so this trader is hedging to the downside and not too sure, but if it does rally, if Google does rally somewhere between here and here, they could be very profitable. Okay, so that's somewhere between 136 and 145. Okay, you can see they could make essentially, once it expires around December 29, potentially make $387 for each of these trades. Okay, so slightly a little bit below that $400 buying power, but it is well hedged. So that's the advantage of this trade, is if it drops, they won't lose very much. If it goes up, they'll start making money. And if it goes up too much, they'll start losing money. However, we don't know if they have stocks, because if they do have stocks, actually this at the 145 would actually not be a loss. You can see here, for example, if they had 100 shares of Google stock, which is representative of one option contract, you can see here what happens. At 145, they're not going to lose money. It's just essentially means that they're capped in their profit. So this is a strategy that they're using with the back ratio if they have underlying stock. Okay, you can see that if Google goes down to, let's say, 130, they would lose $407. Right? But if they didn't have this back ratio strategy, they would also lose $400, right? So what is the advantage of this back ratio? Well, take a look. If the stock moves up to about 140, this is $645. With this strategy, what do we have? At 140, $1,000. You see the profit has essentially increased by a lot more by just putting on this strategy. There's not much downside to this trader, right? If it goes down, they lose the same amount. If it goes up, they'll make more. And so this is why they're using the back ratio, right? Because they most likely have underlying stock on Google, and they're using options to maximize their profits. It's the optimization, all right? And so this is why, if you understand how to use options and strategies in conjunction with stocks, you can optimize profits. And this is what these wealthy investors do. And this is what our specialty is. We look at what these wealthy investors are doing. We analyze what their trades are to understand what they think is going to happen to stocks. And then we trade based on their information, right? If you're interested in more of our work, make sure to go to our website. Put a link here. You can learn how you can also optimize your profits with our strategies. Lots of videos on our channel to teach you and show you how we do this. You can also join our membership and gain immediate access to the best stocks out there that can optimize your profits, because the wealthy investors are trading them because they know something is going on with the stock behind the scenes, right? Have a good weekend, everyone. Smash the like button. Take care.